I appreciate you watching another video from Netpicks. And this one here, we're going to discuss the 3-bar reversal pattern. And that's just a bullish or bearish candlestick chart pattern. And before I do and continue on, let me just warn you that a lot of the videos that I've checked out prior to this, they make it out to be a never fail pattern. And that's absolutely crazy. And I hope you don't buy into what a lot of people are saying. And as always, I want to make sure that if you have not yet picked up your free price pattern guide that I put together, I hope you do. And you can use the link above or below. And back to the 3-bar pattern, you know, the issue for traders, especially day traders, is that you're going to see that 3-bar reversal pattern all over your chart, depending on your time frame and the market you're trading. So it can be a pretty common occurrence. So what does it look like? Here we're looking at a downtrending market, for our example, and we need 3 candlesticks to form a sequence, at least 3, because what can happen is the market can keep retracing, but we can still look for this pattern. So anyways, we're looking for a down candlestick, okay, generally red. The next candlestick is going to have its low below the first candlestick, and it should be the lowest low of the pattern. The third candle or bar, it closes above the candlestick that's in the middle. It's not too fancy, okay? But the pattern's pure price action, and it does have the potential to set you up in some decent trades. Now, this is, of course, is an idealized pattern. In reality, you could actually have several bars heading down or up, and the pattern is still valid. You can still look for it. So let's just take a look at this gold futures chart. Now here, the pattern does not exist because that green candle did not close above the high of the middle candlestick. The idealized pattern forms right here, and at the reversal, you will look to establish a long trading position. And the pattern appears in what starts as a downtrend. And you can see the support zone that price breaks before the pattern appears at number 3. Using the 3-bar reversal in conjunction with support and resistance, as well as other patterns, it's pretty good practice. And like I said, you can have more than 3 candlesticks in the pattern, but what we have to see is that the middle one that you're looking at, the low or the high, okay, that's the turning point in the pattern. And I mentioned that you can see it quite a bit, especially day traders, when they're using lower time frames. So one way that traders could look to cut down on the number of opportunities is to add some type of confirmation. And generally, that's going to be that the third candlestick or bar closes above the high of the first and the second candlestick. Think of an engulfing type of candlestick. So having this confirmation, does it increase the odds of winning trade? Well, obviously, you're going to have to test that out over a large basket of trades. But in my opinion, maybe. Right? There's no hard and fast yes or no unless you've done the testing. Now, requiring the close to take out 2 candlesticks, well, that's going to show momentum hitting the market. And that could be enough for you to take at least a small profit on your trade. That's why I said maybe. But one thing that it's going to do is going to remove trading opportunities that could cut back on your over trading throughout the session. Now, here, I want you to notice I did not choose a perfect example. This one has more than 3 bars. And while sure, having a few bars, it could show more urgency in the move, a larger pullback could entice more traders to jump into the continuation. So the key for me is that in the example of looking for a short position, the first candlestick closes green, which is a bullish move. The second candlestick needs the highest high, and it forms a pivot, right? A price pivot. And that's our turning point. The last bar closes under the low of the first bar, and that's enough momentum to wipe out the gains from the prior 2 candles. Now, from a logical sense standpoint, this pattern does make sense, but it has to show an edge in your back testing. So what about a strategy? Well, one key element is to look for a market that is trending. And you can determine that by simple price action using higher highs and lows for an uptrend, lower highs and lower lows for a downtrend. And a mix of both would equal a market that's in a trading range. So looking at this 1 hour Forex chart, here's what we got. The red X Now this shows an incomplete pattern, as that third candle, it failed to close above the high of either of the candlesticks. The green line shows a completed pattern that you could trade. Now the price pattern completes and a buy stop order is placed above the high of the trigger bar, number 3. Okay. Your stop loss could go below the low of the pattern. In this case, it's a long, so it would go below it. Your profit target could be a trailing stop under the low of each swing once the high is broken. Now we could consider making the pattern more reliable if the pivot, the second candlestick, is actually coming into previous higher lows or confirmed support and resistance levels. But there are some pitfalls. If you're using a structure such as support and resistance, how do you even know that the levels you're looking at are meaningful? So the lines that you choose may have no meaning to the market. So you have to define the rules that you use to determine what's a reliable support and resistance level. Now, since the trade position is entered at the break of the higher low of the third candlestick, your stop loss could be well away from our entry price. And this is especially true because we look for a momentum bar to take out the 2 bars if we're trading the confirmation method. Your position size obviously is going to have to decrease to compensate for the entry and the stop distance, and that may just limit the markets that you can even trade. And do you know what a failure looks like with this pattern? Well, just as important as knowing what a successful pattern looks like, you have to know what a pattern that has failed looks like. So if a successful 3-bar pattern is a close above both candlesticks or bars, I would consider a close below the high of the pivot candlestick a failed pattern for an uptrend. And we could be entering a trading range, and I would just exit the trade. I wouldn't wait for my stop to get hit. So let's wrap it up here. You got to test this out over the instruments that you're going to be trading. And yes, there's some logical sense behind this pattern, but all patterns fail. Your risk is vital, and ensure that you take your stops the moment that they're challenged by price. And you may decide to combine it with other trading indicators like the moving average or momentum measures such as the RSI. But whatever you do, write down your trading rules and follow them. So that's it. It's a pretty quick little pattern here. Hit like, hit subscribe, leave a comment, and we'll talk to you soon.